Good day, Professor and everyone. My name is Yeap, and today I'll be presenting my evaluation of the question, can cryptocurrencies ever achieve true market efficiency despite fragmented global regulations? Using the case study, crypto, Bitcoin mining, and environmental concerns, together with Pharma's efficient market hypothesis, 1970, and risk-return theory, I argue that cryptocurrencies cannot currently achieve true market efficiency. Instead, they exhibit only conditional market efficiency because fragmented global regulations create regulatory arbitrage, information asymmetry, and persistent market distortions. First, let's compare cryptocurrencies with traditional fiat currencies. Cryptocurrencies offer much higher return potential, but they also carry significantly higher risks. As highlighted in the case study, these risks include extreme price volatility, technologically barriers, illegal activities such as money laundering, environmental concerns from Bitcoin mining, to regulatory uncertainty. In contrast, fiat currencies are issued by central banks, operate within a regulated framework, and therefore provide greater stability with low investment risk. According to the risk-return trade-off theory, investors expect higher returns only because they are accepting much higher uncertainty. Bitcoin clearly illustrates this relationship. Next, I evaluate cryptocurrency using Pharma's efficient market hypothesis, which consists of three forms. First, weak form efficiency. Historical prices are reflected relatively quickly in cryptocurrency markets. However, investor sentiment, speculation, and social media still generate abnormal short-term price movements. Therefore, cryptocurrency is only partially efficient under the weak form. Second, semi-strong efficiency requires all public information to be immediately reflected in prices. However, cryptocurrency markets operate across different countries with different regulations, exchanges, and inconsistent disclosure requirement. Information is therefore not distributed equally among investors. As a result, cryptocurrencies fail the semi-strong form. Finally, strong form efficiency. This assumes that even private information is already reflected in market prices. The collapse of FTX, insider advantages, and exchange failures clearly demonstrate that this assumption does not hold. Therefore, cryptocurrencies cannot satisfy strong form market efficiency. The biggest challenge comes from international finance. Unlike traditional financial markets, cryptocurrency operates globally, but regulations remain local. For example, the case study explains that China banned cryptocurrency mining, causing mining companies to relocate to mining-friendly states in the US, such as Texas, Montana, and Arkansas, while New York City introduced restrictions because of environmental concerns. This creates regulatory arbitrage, where firms move operations to jurisdictions with lower taxes, cheaper electricity, or less restrictive environmental policies. Consequently, capital flows, mining activity, and investor expectations continuously shift across countries. These movements are driven by regulatory differences rather than market fundamentals, creating persistent market distortions. Based on my evaluation, I'm proposing a framework called Global Crypto Market Efficiency Framework. This framework consists of 5 pillars. Firstly, the global regulatory harmonization to reduce regulatory arbitrage. Second, mandatory exchange transparency through consistent disclosure and independent auditing. Thirdly, standardized ESG and energy reporting so investors can evaluate environmental risks objectively. Fourth, international anti-money laundering and know your customer standards to reduce illegal activities. Fourth, real-time blockchain reporting to improve transparency and reduce information asymmetry. Together, the 5 pillars can strengthen investor confidence and move crypto markets closer to semi-strong market efficiency. In conclusion, cryptocurrencies currently cannot achieve true market efficiency, although the blockchain technology provides innovation, decentralization, and global accessibility. Its efficiency is undermined by fragmented regulations, regulatory arbitrage, information asymmetry, and geopolitical intervention. Therefore, my judgment is that cryptocurrency exhibit conditional market efficiency rather than true market efficiency. Only through coordinated international regulation, stronger governance, transparent reporting, and ESG integration can cryptocurrencies gradually evolve towards a more efficient global financial market. Thank you very much.